Hi, my name is Stephen Nolan, Managing Director of UN-convened Financial Centres for Sustainability and the Chairman of this year's Climate Finance Week, the fourth in the series. Forgive me for starting this session slightly late. We've run over from the previous session, but I'm thrilled today to be focused on carbon markets, an evolving landscape, and a private sector briefing. A short session. We're joined by Bo Jin, who's at Bloomberg New Energy Finance and their lead on carbon markets. Bo, are you there?
Yes, I'm here.
Great.
Thank you,
Bo,
Stefan, for the introduction.
Thank you. I think you're joining us from London, is that correct?
Yes, that's correct.
And you guys
We
are
finally
busy
have
right
a sunny
now.
day.
Thank you. You're busy right now. You've got your European event next week. So, Bo, thank you very much.
Yes,
and if you want to introduce yourself, and then we get straight into your presentation, please.
Sure. Just before we start, I want to say hello, everyone, and hope you enjoy the talks and discussions this week. My name is Bo Jin, and I am the lead analyst for European carbon market at Bloomberg NEF. I have a small presentation here. If you can see my slides. Great. Just a few words on Bloomberg NEF. BNEF is a strategic research provider covering global commodity markets and disruptive technologies driving towards low carbon economies. We assess pathways for the power, industry, buildings, and transport sectors to adapt to this energy transition. And today, I will walk you through 5 key messages about carbon markets with a focus on Europe. First, carbon market is a powerful tool. As the saying goes, there is more than one way to crack eggs. That also rings true for regulating carbon emissions. That said, we can roughly group the different ways into 3 buckets: direct regulation, carbon tax, and market-based carbon market. Each has its pros and cons, and governments tend to use a combination. The main benefit of direct regulation is certainty on achieving targets and low administrative burden. On the downside, there is no incentive to go beyond the mandated level, and it doesn't lead to least cost abatement. Also, it doesn't generate funding. Tax, on the other hand, can raise revenues for the government. It is also clear on compliance costs, but the cost may be too high or too low. It also doesn't guarantee emission reductions, let alone least cost abatement. We see that carbon taxes in 2030 will be too low to achieve Paris goals. Then we have market-based carbon markets. There are 2 types here: cap and trade and baseline and credit. Cap and trade carbon markets, like EU emissions trading system, EU ETS, caps the total level of emissions and allows companies to trade carbon allowances with each other. There are 4 advantages with a system like this. Lawmakers can guarantee total emissions. They can guarantee cost-efficient reductions. They can guarantee earmarked funding, and also the ability to link with other trading systems. That said, this kind of cap and trade market has disadvantages too. It can be hard to implement, and it is sensitive to overlapping policies. Baseline and credit schemes are markets with intensity-based caps. Their advantage is that they allow more flexibility, but their drawback is that they cannot guarantee an absolute amount of emission reduction. One thing to keep in mind here is that we have only talked about how to discourage pollution. To promote new clean technologies, there are other options available as well, like subsidies, auctions, and so on. To speed up decarbonization and reach ambitious goals, we will need both carbon pricing and also incentives for clean technologies. Let's look at cap and trade market more closely. How does the system really work? In a cap and trade market, the total emissions of all participants must fall under the overall cap. Emissions allowances, which gives the holder the right to emit 1 unit of carbon, are traded to balance the supply and demand. Business as usual emissions, here in blue line, represent the overall demand in an ETS emission trading system. The legislated cap, which is the red line here, defines the supply. The difference between business as usual emissions and the cap is the demand for abatement. And this demand is then met by technology or field changes, or by influencing consumers to reduce demand. The EU ETS has shown that a cap and trade system can be effective. Emissions have declined in all sectors since 2005. The total emissions have dropped over 31% in 2020, and power sector emissions have plunged 45%, mainly driven by coal to gas fuel switching. Some of these emissions will bounce back this year as Europe recovers from the pandemic and coal-fired generation is back in the money. The second message is that carbon markets are getting bigger in volume and scope. Carbon pricing mechanisms have spread like a raw egg on a frying pan. Today, many countries with net zero targets have introduced carbon pricing. We have a total of 30 carbon markets and 34 taxes in force, representing over a fifth of global greenhouse gas emissions. The total value of global carbon markets grew 20% in 2020, reaching a record 230 billion euros. This amount is more than 5 times the value in 2017, and most of this growth is attributable to the European carbon market. Let's have a look at the biggest markets. The European carbon market, the EU ETS, is the oldest and largest market in terms of traded value. The ETS covers roughly 40% of EU emissions, including emissions from industry, power, and intra-EU aviation. Upcoming reforms will make this market tighter and add new sectors to the market. The new Chinese market that started this year is the biggest market in terms of emissions covered. The market currently only covers power sector, and it has an intensity-based cap. As a baseline and credit scheme, it may not deliver the absolute emission reduction. Other notable markets include California and Korean cap and trade markets. As a result of rising carbon pricing and a new carbon market, there has been an increasing need to protect from carbon leakage, which is when industries relocate to countries with lower carbon costs than original country. EU plans to start its carbon border adjustment mechanism scheme in 2026 and charge imports based on their embedded carbon emissions. So how did European carbon price become the highest traded carbon price in the world? The truth is, it wasn't easy. The price went through a roller coaster, starting from the initial fall caused by high levels of free allocation and recession in 2008. Imports of carbon offsets caused the price to drop further. European carbon was then hanging in the valley of despair for many years before the reforms of the system started to drive new activity. And this was when speculators started to pile in and drive the carbon price upwards. The EU is reforming its ETS at the moment to ensure that the system, the carbon market, remains in line with the higher EU-wide target of 55% emission reduction compared to 1990 levels. And these reforms will lead to a tighter market and even a higher price. Our third message is that current focus is on power sector, but increasingly extending to other industries. In terms of decarbonization, the first main evidence has been fuel switching, which is when utilities and industries shift between the use of different fuels, most importantly from highly polluting coal to less polluting gas. The level of carbon price needed to trigger coal to gas fuel switching is a function of current coal and gas prices and has changed over the years, shown here as the blue range. Record levels of fuel switching took place last year, mostly because of low gas prices and a relatively high carbon price, which made gas plants more profitable than coal and lignite plants. The trend has reversed this year, with some coal generation coming back into the money. This has led to more coal running hours and higher overall power sector emissions. And this also leads to more European carbon demand. Towards the end of this decade, as fuel switching will be mostly exhausted and power sector largely decarbonized, there's going to be an increasing pressure for other sectors to decarbonize. In addition, the proposed carbon border adjustment mechanism, we just mentioned earlier, should bring about the end of reallocation for industries. The question then becomes, how can industry decarbonize? Currently, their options appear to be quite limited and expensive. Hydrogen or biofuels may be an option for some sectors, and carbon capture, utilization, and storage could be the answer for others. We will likely need a combination of all three and some electrification, and maybe also help from technologies that does not exist yet. Although the European carbon price has risen rapidly, it is still below the level required for green hydrogen, priced at $2 per kilogram, to compete with the cheapest fossil fuels in use today for many industrial applications. And this $2 per kilo is the benchmark which we see could be achieved this decade. As for the future, European carbon price will continue moving upwards to boost this industrial decarbonization. And as for which industry will use green hydrogen first, we see that it's going to be coal-based steel production sector, and they will be the first application to reach this competitiveness. And same story really applies to carbon capture, utilization, and storage. The current European carbon price is above the lower range that could theoretically make CCUS competitive for several industrial applications, but these costs reflect the price once carbon capture, utilization, and storage technology has been scaled up. Today, the projects are not yet able to achieve these prices. The fourth message is global carbon trading could facilitate faster decarbonization, but is not yet a reality. This is quite a timely topic as we prepare to start COP26 in Glasgow. The most important article for carbon market is Article 6 of the Paris Agreement. It's the goal to establish an integrated global carbon market-based mechanism. The negotiators have twice failed to reach an agreement on the rules for this market, and now the earliest the rules can be agreed is in Glasgow. There's definite benefits with having a global carbon market. Global carbon trading could save $250 billion US dollars a year in emission reduction costs in 2030. And reinvesting these savings could reduce global emissions by a further 5 billion metric tons a year in 2030, according to a study by IETA and CPLC. But then there's also risks involved. Launching a global market could threaten environmental integrity if implementation or regulations are weak in some jurisdictions. Also, residents may prefer decarbonization of local economy over global emissions. The EU used to allow the use of offsets generated under the Kyoto Protocol, Clean Development Mechanism, and joint implementation for compliance before 2013. The huge supply of offsets, together with over-allocation of free allowances, led to a price crash we saw earlier between 2008 and 2012. The problems associated with the quality of offsets also destroyed the credibility of carbon offsets. The price for a certified emission reduction credit under Clean Development Mechanism fell from over 22 euros per metric ton in 2008 to 1 cent per ton in 2015. Currently, Europe doesn't allow the use of offsets in the compliance for EU ETS. Taking a look at the voluntary market, we see quite a different story here. Offset issuances have spiked since 2019 after years of stagnation. Some 100 million offsets were issued then, followed by a record 185 million in 2020, and through September this year, around 270 million offsets have been issued. But just to put this into perspective, compared to European emission trading system, this is still quite small market. The EU has a cap of 1.6 billion allowances this year. So there are three factors supporting the growth of voluntary market. And those three are first, companies in hard to abate sectors. They are setting emission reduction targets, which creates offset demand. Some 2/3 of world's heaviest emitters in the Climate Action 100 Plus have set a net zero target or equivalent, which adds to offset demand. Then we have a number of policy development and standardization efforts, which have been boosting the credibility of voluntary carbon markets. Groups like Task Force on Scaling Voluntary Carbon Market and registries like Verified Carbon Standards are helping to standardize and validate the market. And there has been also efforts done to make trading easier. CBL started to offer the first physically settled voluntary carbon offset on exchange this year. Then finally, technology is also helping. It's improving the credibility of offset projects. Startups are using drones, LiDAR, and satellite imagery to track emission reductions from forestry and agriculture projects. And this makes sure that these projects are real and traceable, and these emission reductions are accredited with additionality. So carbon offsets can be useful as they allow companies to meet targets before the true abatement technologies become available. But there's no free lunch. Allowing the use of offsets can distract the industries from the need to act now to drive down the cost of new technologies and scale them up. So setting separate systems for abatement and carbon removal could ensure abatement while enabling more ambitious companies to drive additional emission removal outside of their core business. That leads us to our fifth message, which is higher carbon prices are attracting financial investors. Higher prices and volatility have led to an influx of speculators. The number of entities investing in European carbon futures, which are not under the EU directive, rose to record high. The group has doubled since the beginning of 2020, betting on carbon price moving upwards, mainly because of the reforms and market tightness in the future. The impact of speculator in the market is that they can provide liquidity, but also volatility depending on their strategy. Day traders could cause price spikes, especially if the market is trading on thin volume. But investors with longer horizons, like pension funds, could also bring price stability as they have a longer investment horizon and invest from a fundamental perspective. The main reason for financials rush to carbon has been returned. EU emission allowances, EUAs in short, have outperformed the S&P index and a group of US ESG mutual funds in the year-to-date, last year, and for the past 3 years. The reason for carbon's attractiveness is that the investor can tap into green growth without taking a position on a specific company, technology, geographic market, or entry timing. The carbon price generally tracks the cost of the most competitive low carbon technology, and it has an upside of future scarcity. Another benefit of carbon is that although as an actively traded commodity with derivatives, it can be volatile, it's unlikely to reach the level of volatility seen in other areas like meme stocks or cryptocurrencies. Ultimately, the carbon pricing is a tool for the EU to drive its climate policy. The speculator influx has prompted a discussion around the need for additional stability mechanisms like position limits. We don't really see that holding limits like we have in a California cap and trade system is really required in Europe at the moment. And there are 4 good arguments why European markets can work without them. First is that holding limits could lead to lower liquidity and weaker price discoverability. And this could curb the ability of compliance entities to manage their carbon costs and hedge their carbon cost exposure in the most efficient way. Another argument is that carbon should be a strategic consideration for compliance entities. So short-term price movement should not affect a company's long-term carbon strategies. Volatility may even encourage industries to take a longer horizon in their risk management and opt out of the behavior of selling their free allowances for quick cash. Then we also already have existing tools that look after market stability. European emission trading system has a cost containment mechanism that addresses sudden price spikes. There's also a tool called Market Stability Reserve that looks after European carbon market balance in the long term. And then the last argument really is hedging. There has been a concern that long-term funds, pension funds, for example, may decrease liquidity because they bank those purchased EUAs. However, we have utility hedging that is falling because of coal phase out, fuel switching, and also renewable builds. There will be supply coming to the market that will need to be absorbed. So funds with long-term investment horizons could play a role in preventing the market from being flooded. And these are the 5 messages about carbon market that I wanted to take away today. Carbon pricing is a powerful policy tool. Carbon markets are getting bigger in volume and scope. Current focus is on power sector, but increasingly extending to other industries. Global carbon trading could facilitate faster decarbonization, but it's not yet a reality. And finally, higher carbon prices are attracting financial investors. Thank you. I'm happy to take questions.
Can you hear me, Bo?
Yes, now I can hear you.
Great. Sorry, I was just saying I really enjoyed that, and I found that fascinating. And again, that's what Bloomberg New Energy Finance brings, right? You're, I think, a few hundred people at this point now around the world. You're experts, not just in carbon, but across a lot of different other verticals, and under that Bloomberg brand. And I know you're going to have a big presence at COP this year as well. So just, Bo, I just have one question, if I may, actually, one question. And you mentioned a powerful policy tool. We had Jim Barry from BlackRock on just before you came on, and he was talking about the role, policy to really crowd in private capital, perhaps, first percentage of risk, and particularly around emerging markets. And we also had, from a regulatory perspective, the governor of the Irish Central Bank of Ireland was good enough to be interviewed this week, and he spoke about the importance of carbon pricing as well, and echoed, some things that you're talking about here in terms of your key message, and in particular, as I said, a powerful policy tool. We have one of the biggest policy things coming up in the next few weeks, which is COP, right? Frantic negotiation going on right now. As I said, I know on the 4th of November, Bloomberg New Energy Finance will be there as part of Energy Day, but the 3rd of November is on finance, Private Finance Day, and it's, mobilization of capital, risk management, returns, and climate disclosure and reporting. How important, in the context of what you just been talking about, is COP? Or is it just kind of an event, or is it really important as maybe a catalyst to the next phase of the carbon markets evolution? Please, Bo.
Yeah, that's a good question. As I mentioned in the presentation, in terms of COP26, the main article for carbon market is Article 6. But also mentioned in the presentation, there are benefits with having a global carbon market, but also there are drawbacks with having a global carbon market, and mainly that's associated with environmental integrity. And also in terms of more practical things, the negotiators have already failed twice to reach agreement on the details on what is being traded. Is it emission reduction? Is it emissions avoided, or something else? And also, what is the mechanism or platform being used? So there's going to be a lot of negotiations needed to reach an actual agreement. So maybe the upside or the potential there is a bit limited. I think the bigger potential and bigger impact is for COP26 is countries to have to set more ambitious climate goals and set up their own carbon market. For example, we have mentioned about carbon border adjustment mechanism. It's basically a stick for other governments to step up their climate actions in a way that if countries without a carbon pricing, if industries from those countries are importing to Europe, they will need to pay a fee when they enter Europe. Then these governments should think, do they want to keep this kind of climate revenues themselves, or are they allowing Europe to take this income? But the ultimate goal is to have carbon markets set up outside of Europe as well. So carbon border adjustment mechanism, it would be just a scare instead of actual mechanism that will happen, because it's in terms of global decarbonization, it's not really benefiting that much to have a lot of administrative burden associated with decarbonization. So ultimately, COP26 could be the platform to set up ambitious goals and also set up carbon markets for different countries, and with an upside of potentially this Article 6 and global trading without hurting environmental integrity.
And thank you for that, Bo. And again, just that perspective you bring. I'm just going to one last question, because I know we're due to close shortly. We mentioned, and I know you talked about the California cap and trade and the US, but from your perspective, and we had a panel last night. It was focused on 10 months into the Biden presidency, just kind of climate finance action, and we had it was focused on insurance. We had the state insurance commissioner from California. We had the advisor from Washington State and the head of sustainability and climate in New York, Department of Financial Services. Just fascinating watching the momentum in the last 10 months within the Biden administration. I suppose, maybe it's a tough question, but from your perspective, that momentum, are you seeing that come true in terms of your research, client engagement, more and more US firms approaching and asking, how do we do this? Or are you seeing real action?
Yeah, there's definitely a momentum behind carbon, and there are quite many reasons for this momentum. One is that carbon has shown that it works, that it's a great tool to bring transparency to decarbonization. It creates a price signal for utilities and industries to invest in clean technologies. And European carbon market has been good at providing evidence of this energy transition. And then the momentum also comes from that the carbon market, you can make money in the carbon market, and that you saw that in my slide of comparing different returns. So the ability to create that returns that is exceeding the equities and also other mutual funds is also boosting that momentum, where not only it's showing creating visibility for compliance entities and industries and power sector, but also creating investment opportunities for the banks and the funds and other like investment groups.
Great, and thank you for that, Bo. So look, I'm going to close there, Bo. Bo Quinn from Bloomberg New Energy Finance. I want to thank also Benji Caffrey for facilitating your support today. Benji's a great friend and a great friend of what we do here in Ireland and also UNFC4S. So thank you very much, Bo. And I know you guys are incredibly busy with what is a fantastic agenda next week. I know it's a hybrid event. I'm looking forward to dropping over, and it's great to be meeting Benji and co in person again after the last 2 years. So look, Bo, thank you very much for giving us your time today, and I really, really enjoyed that. Thank you, Bo.
Thank you, Stefan.